This episode of the Commercial Real Estate Investor Podcast is brought to you by my CRE Accelerator Mastermind, where you'll get access to my step-by-step investment blueprint, essentially a library of resources on how to invest in commercial real estate. You'll get connected to a supportive community of other commercial real estate investors that are doing projects just like you. You'll get personalized coaching and feedback from me every step of the way. Go to www.crecentral.com to learn more. Welcome back to the Commercial Real Estate Investor Podcast. We are live with another Investors Roundtable today, diving into an issue that is facing a lot of investors, most investors, everywhere. How to make deals pencil with today's interest rates. That is a huge challenge. How do you make commercial real estate deals profitable? What strategies can you use to structure these deals, optimize your financing, and find opportunities even in a high interest rate environment? Joined, as always, by Matt Anderson and Logan Freeman. Gentlemen, thank you for being here. We're going to kick it off with a question for Logan. Talking about loan options in a high interest rate environment. What types of debt really work best in a market like today?
Yeah, look, in this environment, obviously financing is the fulcrum of deal success. And I always want to make sure I'm putting people up on game. That's a great word to be using while you're deal making. It's the point on which a lever rests or is supported on and is pivoting. Okay. And we're seeing a lot more creativity on the debt side, especially as traditional financing like fixed rate options, they're not penciling without serious concessions on price, right? So bridge debt is still a tool in the box, but lenders are being a little more conservative than what we have seen previously, and spreads are still pretty dang wide. You know, we're seeing floating rate loans with rate caps being used, especially with investors who kind of anticipate a rate pivot in the next 12 to 24 months. But, you know, hedging those costs can really eat into your returns. So you have to, really underwrite conservatively on the exit. One example is we recently worked on a multifamily value add deal where the buyer opted for a 3-year bridge loan with interest only payments, knowing or feeling like they could drive NOI through renovations, right? And then refinance into permanent debt once those rates stabilize. Now, this is allowing them to pay slightly more upfront, knowing their CapEx plan would push returns later. So, look, I think the other thing is like assumable debt's becoming a huge deal maker, right? We were the beneficiaries of locking in 10-year debt, 4 years ago at, 3.76% and was able to sell a deal in or outside of Des Moines, Iowa for a 4.2% cap rate, right? It made the pricing work despite, the issue with the valuation, right? And that was an incredible tool here. So I think that's a big component, is assumable debt's becoming definitely a big deal maker for a lot of these projects. And then, like we talked about a few weeks ago, but like seller financing is also reemerging. I just saw another project. That guy owns just an office building outright. And he's like, hey, I know debt's kind of hard to get right now, so I'm willing to do X, Y, and Z on this deal. Another one came into my inbox earlier this week, a deal down in Houston, Texas, that they had negotiated 92% seller financing, right? So I think that's reemerging, especially in deals where, the sellers have low leverage or they're motivated to move assets without taking a valuation haircut. So I think the key takeaways from a deal making standpoint right now is, flexible structures, lots of bridge, negotiating interest only. People are still using rate caps, and there's a lot of seller financing. That's allowing buyers to try to protect cash flow while positioning for maybe more rate stabilization and liquidity here in the near term, in the next 12 to 24 months.
Matt, Logan mentioned a few times, rate buy downs, interest only periods. Let's talk about some other lender concessions. You can negotiate with lenders for better terms. So, what are some effective ways that you're seeing right now that investors could utilize to negotiate more favorable loan terms?
Yeah, and this is one of the reasons I've been focused on value add. There's a lot of reasons, but we really like the loan where we get a couple of years interest only while we're repositioning an asset, while we're getting a 5 to 7 year fixed right in there at the same time. Because I think what a lot of people do that's a little risky is they'll do the bridge loans where they're kind of if they don't do a rate cap, especially, or do something to combat it, they're kind of hanging out there in a few years if the
Yeah.
market doesn't do what they expect. So I really think that you want to do a couple different things at the same time, which is you want to maximize the cash flow, but you want to make sure you're going to be safe on the DSCR, on the back end, and you want to make sure you're not going to be stuck after rates go up again. Because the reality of it is nobody knows what's going to happen, right? I mean, a lot of people were saying last year, well, we've probably seen the top of rates. Like, they're probably going to go back down. And here we are. We still have no idea what the hell's about to happen. I mean, I don't really, I'm not predicting or expecting rates to go up, but I want to do my deals in a way where I'm maximizing the upside and, interest only. It can be a good way to do that for cash flow, but I don't want to be stuck in any situation and be beholden to the market no matter what.
That's right. Yeah, I mean, you want to control your destiny as much as possible in an environment like today. I mean, and honestly, at the end of the day, that may just mean bringing more equity to the table. Maybe you've got to bring more cash down to just make it safe. There's a lot of different ways for you to really approach this. And plus, look, if you're the investor that's bringing 35% down, a bank may be more willing to negotiate some of their terms than somebody that only wants to put down 20, right? Because they're going to look at their leverage position and realize that they have far less risk in it than they could. Right. So I would certainly encourage you to go out there and explore alternative financing methods. There's a lot of different ways that you can structure these things. Logan, let's dive into underwriting and deal structure, because I mean, running the numbers today, you've got to be conservative. I mean, what are some underwriting adjustments that y'all are making and that you recommend for today's rates?
I think underwriting right now must prioritize two different things. One is debt sensitivity, right? So modeling the impact of rates moving up 50 to 100 basis points during the hold or refinance. And I know that sounds wild, but I mean, we're all watching inflation prints and we're all watching retail sales come in at the lowest they've been here for quite some time. And so, I think that's number one is, hey, we got to have some sort of sensitivity around this debt, and if rates move up, where are we going to be? And I do think the last 2 to 3 years probably taught people that, but we're just like real estate is a cyclical market. Investors are always entering into the marketplace that maybe weren't involved in transactions previously, right? And so I think that's one thing. The second thing I think that you have to look at is NOI durability, right? Ensuring revenue upside isn't speculative and expense growth is realistic. I mean, do we really know where insurance is going to be with all of these natural disasters and fires and all the things that are happening? I mean, I think that's a huge component to real estate underwriting right now, right? Is understanding, can my NOI really withstand, a big jump in insurance costs or operational costs or labor costs. So, I think we're testing deals against a 7 to 8% cap rate, even if we believe the market's going to revert maybe back to, the low 6s or 6.5. We have to have kind of this margin, for error. I mean, I'm just underwrote a deal that we'll be bringing to market hopefully soon. And I was like, look, I have a couple investors that were interested in it. And I said, look, this is a project that you cannot look at from a cap rate compression standpoint, meaning we have to look at the actual cash flows. And they're like, what can it be? And I'm like, well, I can tell you what it could be, but like at the same time, those days are gone in regards to underwriting. So there's been a fundamental shift from looking at, or I guess applying the greater's fool's theory that everything's just going to go up the last year or two as rent growth has been flat in a lot of these different markets. Not Kansas City. We've been holding strong, at 3.5% year over year, rent growth on the multifamily side. But at the same time, I think that you really have to give your NOI a durability stress test on different expenses, because one thing that we don't ever really, a lot of people don't talk about is, are your expenses actually going to outpace your rent growth and the rents that you can actually charge? And so, I mean, we recently underwrote a multifamily asset where the, going in cap rate was, sub 5%, right? And the buyer's debt was at 7.25%. that's negative leverage on day one. So to make it work, the focus shifted to what can rent growth assumptions actually be? And instead of saying, what do we think it can be? What is the current rent roll actually getting on renewals and new leases? Let's start there. Then we looked at, okay, well, maybe there's some operational efficiencies here, but it's not going to be on shopping the insurance around and getting a better insurance quote, or, some of these other things that I've seen in the past, and a business plan, trying to create a business plan to push the NOI above, 8%, within 24 months. Without that NOI growth plan, that deal is dead, right? And so, we're also baking in, I would say, longer and extended hold periods. The 3 to 5 year kind of flip mentality is shifting. And I think buyers need to be comfortable holding for 7 to 10 years if rates stay higher for longer, right? And that long-term horizon, that really does ease your pressure on the exit cap rate. So I think my key takeaways on this underwriting right now is you got to stress test everything. I'm loving sensitivity analysis, and the ability to kind of really put that through the stress test and assume you're going to refi, maybe at 7 to 8%, in my markets at least, and assume exit caps stay wide. So if the deal still works at that point, you've got a winner. And I think that you have to look at your IRR partitioning as you're underwriting these deals. And most of this IRR cannot come from, your assumptions that you're going to sell it at a certain price. You got to get these returns actually from the cash flows that are present on the property.
Yeah, I mean, the sensitivity analysis is so crucial for any market environment, right? But especially in today's, I mean, go in there and run it, right? See what it would look like if you get lower rents or higher rents, or your operating expenses change from a 3% annual increase to a 5% annual increase. What does it look like if, your CapEx budget ends up being higher? What if your exit cap rate is higher, right? Go in and run those numbers and be realistic with yourself, because the only person that you are doing a disservice is you if you run those numbers wrong, and it turns out to be an incredibly different case. Question of the day: what's the biggest challenge you're facing when trying to make deals pencil in today's market? Let us know in the comments. Feel free to jump in. Let's talk about it. Matt, let's talk about cap rates and really kind of planning for the exit, right? Because just like what Logan was talking about, I mean, there's a chance that your cap rate's actually going to be higher on the exit in today's environment, which for years analysts have been underwriting it to be lower, right? It's just not realistic anymore. So, I mean, how do you determine if a deal still makes sense given current cap rates?
Well, I just look at it very simply. I've always done this really, which is, you're looking through your numbers and, well, my exit cap rate is at a 7 or a 7.5. Well, let's make it a 7.5 to be safe, right? That's how most of us have always done it, right? We've gone with the more conservative numbers across the board, and because we know as deal makers, things go wrong, things take longer than expected, unknowns happen, and you need that buffer. And so, really, what we're dealing with is just a time where that's doubly true. And so, really, you take for me, what I do when I run my numbers is I look at all the worst case scenarios. Now, when I'm running these numbers, I'm trying to think of solutions, right? I'm trying to think of different structures, different money raising, different financing options to make the deal work better. But at the end of the day, I want to look, what is the worst cap rate? And I'm going to be a little more conservative. I'm going to say that the cap rate's going to stay flat. In some markets, I might actually write for it going up a little bit just to be safe. And I'm going to do the same thing with rents. I'm going to do the same thing with expenses. I'm probably going to right now underwrite rents being flat for a while and expenses potentially going up. What's going to happen with tariffs? What's going to happen, with inflation? We don't know. So it's really that simple from my point of view, which is just putting a buffer in there. If you're going to have a DSCR requirement of 1.2 or 1.25, then underwrite that bad boy at 1.35, 1.4. Make sure you got some cushion there, and that's the simple gist of it. The good news is though that all the other investors are doing the same thing, right? We're all playing the same game. Our numbers are a little different, but I think a lot of the people who got a little too ahead of themselves bought some deals maybe they shouldn't have bought, or stepped out on a limb on financing. I think they've been taken out of the game for a little bit, for the most part. And I think the sellers, sort of flip this on its head. I think the sellers are starting to realize, well, a lot of these sellers have been holding on for a year and a half, 2 years. not selling because they weren't getting the prices they had in their head from a few years back. And I think more and more of them every day are waking up to the fact that this is the new reality too. So I think I don't know. Fingers crossed. I'm hopeful that 2025 is the year that the sellers have caught up. Catch up with us, and we start to see some more deal flow again, and that we can do these conservative underwriting, get the deals to pencil now, and then the rest is gravy. If the cap rates go down, or if the interest rates go down, or if the expenses don't go up, you know, then that's just all extra.
That's right. I mean, it's you think about what was going on 5 years ago. I mean, somebody that bought a deal 5 years ago is coming up for a refinance in a very, very different time. And that's happening this year. And sellers always lag behind buyers, right? I mean, buyers immediately become sensitive to higher interest rates. Sellers, they're like tenants, right? It's like back when COVID was going on, everybody said, oh, office market is dead, but office didn't show any shifts. That's because most leases are on a 3, 5, 7-year basis. So it doesn't matter what happens in any one given year. It's going to take a while for anybody to see fallout. It's the exact same thing when it comes to the debt on these commercial properties. Logan, let's make a shift towards finding value in today's market, especially, right? Identifying opportunities that are likely going to be distressed, right? We're going to have some motivated seller situations. It's inevitable. I know we've all been talking about it for a while, but it seems like it's now 5 years, right? Where are you seeing those opportunities, maybe the best opportunities right now?
Yeah. Well, right now, I think opportunity lies in distress and misalignment between price expectations and reality. And, there's a lot of bridge debt maturities that are forcing owners to sell or refinance at terms they can't afford. And to the tune, I think this year of about $600 to $700 billion needs to be refinanced, restructured, or sold. And over the next 2 years, I believe it's $1.2 to $1.4 trillion. And so they will be doing something with those loans, right? And so, I think that we're seeing a decent amount of motivated sellers, particularly in some Class B properties, but a lot of Class C properties, where CapEx was deferred or rental upside, was overestimated. Thankfully in our market here in Kansas City, we're supply constrained, and most of the new, supply is being absorbed on a pretty rapid rate. But I know that there's other markets like Austin, Texas, and a few others that had a huge amount of supply coming online, that those properties may be in a little bit tougher, position. I think that if they can hold on for the next 12 to 24 months, they probably do okay. But, I think that, for example, we're working on a 50 unit multifamily deal here in Kansas City where the floating rate, bridge debt, that exploded from 4 to 8%. That just crushed the cash flow, right? They need out. And, so this new buyer is going to be stepping in at a 20% discount to peak value. So, they're locking in more favorable agency debt. They're executing a light renovation plan to push rents while riding out the rate cycle, and, I think that retail also has, really surprising upside. There's still cap rates to be had in retail of above 7.5% cap rates, and tenant demand is outpacing a lot of supply in select submarkets. So I think that low leverage buyers can lock in cash flow and ride the recovery, right? The pain to me is in the debt maturities. That's where pricing is breaking, and that's where buyers willing to act fast are winning. And if they have cash and the ability to move quickly, I think that that's going to present a lot of opportunities for these investors this year and the coming years. To be honest with you, what I'm also seeing is the 1960s and 70s product. It is unfavorable out there. Those deals are sitting on the market for a long time because you have to come in and do all this CapEx work to get a property just operational, not adding value to the cosmetic upgrades to get more rents or adding an amenity or something. You're literally just going in and doing mechanical, electrical, and plumbing, because these properties are 50, 60, sometimes 70 years old, and they need work. And there's been a lot of that deferred maintenance. And so that's kind of, causing a lot of people to step out of that 60s and 70s product type and the new 80s, 90s, and 2000s. 2000s is like, that's like the new 1980s is what it feels like out there right now. So I think there's a big, focus on newer vintage product, not just from a construction, standpoint on how it was done, but from deferred maintenance and these CapEx problems. So those are some trends that I'm seeing here in our markets.
Yeah, I mean, the good thing about moving into 2000s product is, I mean, look, when you've got a product that's 20, 30 years old, it's always going to be, a fair amount of work to renovate it. But man, is it not going to be like the 1960s and 70s? You know what I mean? Like it's pretty great to see because we've got, I mean, the building codes were entirely different by the time the 2000s hit as opposed to the 60s, 70s, and a lot of the issues that made some of that product the most undesirable for anybody to touch it was pretty much moved out of the way by the time the 2000s came along. So, I mean, look, in 2000, you're dealing with a lot of PVC already, right? You're not having to deal with cast iron pipes and chillers and all that kind of stuff, which makes it a lot easier on the renovations. Matt, speaking of renovations, I mean, value add, increasing the value on these properties, increasing the NOI is kind of the name of the game today, right? Because you want to get that cash flow up as high as possible, right? It's just going to help you weather whatever may come. Nothing may come, but it may, help you weather whatever that is. What are some ways that you're seeing investors really boost their NOIs today? And honestly, I mean, the answer could just be, let's get back to the fundamentals. But what are your thoughts?
Yeah, I mean, I think that probably is my answer. I've been seeing a lot of people focusing on expenses right now, because the cool kids were getting the rents to 150% in 2 years, for a while, and that hasn't played out as well recently. So I've seen a lot more focus on expenses, right? So where are there places that we can reduce costs, seeing property management being brought in house, seeing focus on renovations being reduced, or just pretty fundamental really, but a little bit more focus on the expense side, because it seems like some operators have just sort of let the expenses go crazy, especially the ones where they've been operating for a while, and they just sort of let things get out of hand, and so on the deferred maintenance and on the deferred expense side, they just haven't done what they could have done to get that in line. So that's one thing I'm saying.
Yeah, I mean, look, when it's a green market, everybody's doing well. It's very easy for that expense creep to happen. And now is the time to tighten your belt and sharpen your pencils and kind of get back to cutting out all of the fluff and getting rid of all of that. Couple of comments. Let's see. Eminem is saying, do y'all know of any lenders that will lend for value add trucks, truck yards, or industrial outdoor storage? Eminem, I would say call your local lenders, right? Local and regional banks are often the best bet for those types of deals. Jonathan Silva is saying, I'm 22 years old, currently one test away from getting my GC license in Florida. Congrats, Jonathan. That's really exciting. Ziggs44, I'm in retail development right now. Our biggest challenge is construction costs. GC bids are high because their subs are extremely busy and material costs have gone up. Inflation and now tariffs. Yeah, I mean, it's tough to see. We all thought that with interest rates going up, contractors wouldn't be as busy as they are, and unfortunately, nothing is seeming to change. So I don't know where we go. I don't think prices will ever come down, which means that the only other option is that rental rates or whatever has to go up to accommodate for it. I mean, Matt, Logan, any quick thoughts on that?
Yeah,
Well,
I think. Go ahead, Matt.
Well, I was just going to say that's why I've been so fixated at buying things below replacement cost for so long, because I just don't see how that's going to go away. And so it's really nice to be able to be in a building where there's good supply demand dynamics, and you're paying $100 to $150 a square foot for it. It costs you double that to build it right now. So
yeah. I mean, I think that, if you're in retail development, spec development's pretty well out, I think, at this point. But, what we're seeing be successful is the ability to get a tenant and work out that lease, from day one, and go find the site and say, hey, look, I'm building to this cost. I know that sub-market rents are at this price, but look, I mean, you're going to get a brand new product, and here's what we can deliver, and here's how we can make that work. And I think that, depending on where you're located at, having tenant and tow development opportunities on the retail side is extremely valuable, right? And that allows you to kind of model out your deal, before you go find a site and start building. And, unfortunately, for the tenants, and the businesses, a lot of these costs are going to have to be passed through to them because they need a spot. They're growing their brand. And if you can figure out how to work a couple of those deals, with some of these national tenants or even local or regional tenants, and what they need to pay, you can potentially work something out, and that allows you to figure out your underwriting really quickly. So I think that's one other component is resetting expectations with businesses, with investors, with all of the industry players in the space to say, hey, here's the new normal, right? And that's a term that we've long tried to get away from, but inflation is something that's going to be passed on to these businesses, to the consumer, and developers can't continue to hold on to that. So I think that's something that you have to kind of work through your whole supply chain, I guess, is what I'm saying, from the ground up, literally, as prices on land and everything have continued to go up.
Yeah, I think those are great points. Jonathan's saying, asking, what's the best advice you would give me to become successful in the construction and real estate industry? Jonathan, you're young. Get out there, find somebody that's doing exactly what you want to do, and do everything that you can to go work for them, because all you need to do right now is learn how everything is done. I spent my first 5 years working for somebody else, just learning everything about what they were doing. I think these guys would say the same. One last word that I want to leave with you guys. Focus on the long term, right? It's very easy to get caught up in interest rates if you're looking at it from a short-term perspective. I've said this on the podcast before. I will continue to say it till the day that I die. You can refinance out of a bad interest rate. You can't go back and get a better price, right? Mm-hmm. So if you're able to get a 20% discount on a property today, of course you're paying higher interest rates. Refinance out of it in a couple of years. Plan for that in your carry costs. Thank you guys for joining us on this round of the Investors Roundtable. We'll see you back next time. This episode of the Commercial Real Estate Investor Podcast is brought to you by my CRE Accelerator Mastermind, where you'll get access to my step-by-step investment blueprint, essentially a library of resources on how to invest in commercial real estate. You'll get connected to a supportive community of other commercial real estate investors that are doing projects just like you. You'll get personalized coaching and feedback from me every step of the way. Go to www.crecentral.com to learn more.